Amazon is the largest e-commerce company in North America. More than 190 million people visit Amazon.com to browse and shop. Amazon has had a rough and hectic year. The company's shares are still down from their all-time highs. Inflation, which is eating into Amazon's revenue, is showing no signs of easing up. On the first half of the year, Amazon made a 20-to-1 stock split to make the stock cheaper for retail investors. Not all online brokerages offer fractional shares, so the split opened up the possibility of owning Amazon shares at a cheaper price. The split, while seen as a positive development, was overshadowed by Amazon's problems. Supply chain challenges are slowing Amazon down. Fuel, grocery, and skyrocketing living costs are damaging the online market economy, which Amazon gets the bulk of its revenues from. This year has been a tough one for tech giants like Amazon. The tech sell-off lowered the value of many tech companies. It's only now that the bleeding has stopped and tech company stocks are slowly clawing back gains. Their share prices have risen, but these are lower highs in the bear market. Their stock prices are nowhere close to their all-time highs. Amazon, like its peers, is slowly regaining its momentum in the stock market. In fact, something amazing happened to Amazon stock. Amazon just rose 20% in 1 month. On the 1st of August 2022, it rose by 10% in 1 day. After Amazon's ridiculous rise in the stock price, its gains have outstripped the S&P 500's gains, which have been lagging this year. So what is happening? What is causing Amazon's stock price to rise so quickly? Amazon recently reported its quarterly earnings. The numbers were a disappointment to investors because Amazon lost money, showing its shareholders it had a net loss of 20 cents per share, even though Wall Street had expected it to make 12 cents per share. This isn't much of a surprise since the economy is faltering and inflation means less people are buying frivolously, slowing demand for goods on Amazon's online marketplace. Under normal conditions, this would have been a catastrophe, but since we're in a possible recession, investors are more lenient when companies fail to meet earnings estimates. However, Amazon's stock price rose in spite of its net loss it posted, climbing over 10% in after-hours trading. Investors were optimistic because Amazon actually reported it had made over $121 billion from its second quarter sales, which beat analyst expectations, which projected only $119 billion in revenue because of inflationary pressures. Amazon's revenue was not as horrible as analysts expected it to be. While it is still bad because Amazon had reported a net loss for 2 consecutive quarters this year, the net losses aren't that big of a problem because of growing revenue in some of its business divisions. The percentage rise in Amazon's revenue hovered around 7%, which was roughly similar to what it had at the same time last year, so its growth is obviously slowing down. Amazon is growing at its slowest pace in the last 20 years. To put things into comparison, Amazon lost $2 billion in the most recent quarter while it made over $7 billion at the same quarter last year. Amazon lost money because Rivian, an electric car company which Amazon partially owns, mainly through Amazon's roughly 20% ownership of Rivian shares. It's Rivian's fault that Amazon is losing money. The EV maker could not build Amazon's all-electric delivery vans fast enough. If it wasn't for Rivian's losses, Amazon would have posted incredible profits. Amazon ate $3.9 billion of paper losses in the second quarter. The EV company's inability to meet its production goals is a problem. Amazon is still gung-ho on getting over 100,000 Rivian electric vans on American roads by 2030. Amazon's optimism comes at a time when Rivian was forced to cut its 2022 EV production in half amid layoffs to cut costs in response to the coming recession. Amazon also posted rosy projections of what it would make in the third quarter of the year. According to the company, Amazon expects sales to reach up to $130 billion, which was higher than what investors thought it was. The online e-commerce giant also expects lower operating costs compared to its 2 past quarters. For the first half of 2022, the world was in turmoil. Recession fears were rampant. Recession fears and rampant inflation was raising costs of everyday household goods across America. Amazon may have had the financial might to weather the storm, but investors want growth from Amazon. So when Amazon's chief executive said they were managing costs on top of the rosy third quarter projections, the investors were convinced of Amazon's growth story. But that wasn't the main reason why investors pounced onto the stock. In Amazon's quarterly earnings report, the star of the show was definitely Amazon's cloud computing division. For those who are unaware, Amazon Web Services is Amazon's most profitable division. AWS offers storage servers and networking services to companies, so they don't need to spend money maintaining physical servers, which can be quite costly. Many tech giants and well-known companies use Amazon's cloud computing solution. Currently, Amazon controls over 30% of the cloud computing market and is responsible for over 70% of Amazon's profits. Investors see Amazon's cloud division as its primary cash cow and judge the company's growth not through its gargantuan online e-commerce services, but its small and hugely profitable cloud computing business. Amazon Web Services, the top cloud computing provider in the world, saw its revenues rise by 33% to $19 billion in the second quarter this year. Amazon's ad businesses rose by 18% to over $8 billion in the recent quarter. Together, these two money-making divisions boosted sales, covering up Rivian's lost revenue. It also helped that revenue from both business divisions exceeded expectations on the second quarter, considering Amazon is known for using revenue from its Amazon Web Services to make up for razor-thin margins on its main e-commerce business. e-commerce, investors were happy when they saw one of Amazon's main moneymakers growing in value. Amazon makes less than 10% of its revenue from its e-commerce business. This is nothing new. Inflationary pressures have driven rises in living costs, and with it, the labor market workers are a lot more expensive to hire and maintain. Amazon's shipping costs have risen a lot this year, so operating costs for Amazon's e-commerce segment are much higher now. Investors rarely look for too much revenue growth in the e-commerce market because they know Amazon has most of the market share in America. So as long as revenues from e-commerce are not too stagnant, Amazon investors won't bat an eye, even if the numbers aren't what they are supposed to be. Compared to Amazon's peers, which include tech companies in FANG, like Apple, Netflix, and Meta, Amazon posted better than expected results. Meta on its own recorded its first ever drop in revenue and forecasted a decline in revenue for the third quarter this year. Facebook's metaverse plans are bleeding money, and Apple's new iOS policies have crushed Facebook's ability to sell targeted ads because of privacy restrictions. Amazon's ad business is nothing to sneeze at. Amazon is a large online store, and its ability to place ads throughout its storefront is immense. Profit margins for its ads are much better than the bulk of Amazon's e-commerce business, which has pea-sized margins. Amazon makes only a tiny amount of money by selling goods. The only reason Amazon was about to squeeze a tidy profit out of it was because of how much scale Amazon has. Investors are excited at the prospect of Amazon's entry into the lucrative sports TV ad space. Amazon spent $1 billion to get the rights to broadcast the NFL for 11 straight years. Putting ads on these shows will make Amazon a ton of money. Amazon's stock price have risen dramatically overnight, but its stock price is still lower than its previous highs, which were a result of the pandemic's unsustainable stock buying fervor. Amazon has made a lot of money in the pandemic. Now everything is no longer under lockdown, as people are buying stuff online. More are visiting brick and mortar shops in person. Consumer behavior has shifted. Inflation is rearing its ugly head, raising prices for gas and household goods. Inflation is reducing the spending power of Amazon customers and pushing up Amazon's operating and hiring costs. Amazon is trying to save money by slashing its operating expenses. The company cut its staff by 6% and halted several warehouse and building projects, which were initiated because of the online buying spree, which made Amazon a lot of money in the pandemic. Despite this, some of Amazon's bigger building projects are still underway as they represent Amazon's bets on consumer demand in the future. Amazon Prime, the company's 2-day shipping service, had to go up in price to cover rising costs introduced by inflation. Private label brands which Amazon is known for, like their phone cables and basic electronics, carrying the Amazon brand, had to be cut back and shelved because of disappointing sales. This is a blessing in disguise. Amazon has always faced a ton of backlash from third-party sellers who accuse Amazon of making cheaper goods, slapping the Amazon brand on them and using the platform to outsell other vendors on the site. The government has been paying attention to the situation and was going to intervene anyway. So by reducing the number of private label brands in its catalog, Amazon can avoid regulatory scrutiny and move away from the low-margin private label goods that are becoming more and more expensive to make and justify in an inflationary landscape. It will be a long while before Amazon surpasses its previous highs. Amazon is planning for its future growth while it battles inflationary pressures. The online retailer has purchased a healthcare company. The purchase marks a new step in Amazon's foray into the healthcare industry. Healthcare accounts for a fifth of the US economy, and Amazon believes that disrupting the healthcare sector will be the next big thing. Amazon has operated a small healthcare division for years which focuses primarily on telehealth, which lets its customers meet doctors through the internet. With its purchase of One Medical and all the doctors Amazon could want, Amazon seems intent of capturing a slice of the healthcare industry for itself. There's a lot for long-term fans of Amazon stock to be optimistic about. Amazon is still the leader in online shopping, and its cloud business is growing from strength to strength. The only cloud provider that spends more on cloud infrastructure is Alphabet, Google's parent company, which tossed in $28 billion into its cloud business, eclipsing Amazon's $24 billion. A lot of Amazon's current problems are rooted in its legacy decisions from the pandemic, like its warehouse spending spree and inflation. There are many people who can't decide whether we are in a recession or not. What matters is inflation is definitely affecting the daily lives of many people and shattering their buying power, which doesn't bode well for Amazon. Inflation does not seem transitory like Fed Chairman Jerome Powell suggests. In spite of that, Amazon's troubles are temporary. Once Amazon emerges from the recession, it will be stronger than ever before. Amazon's warehouses, which they have been subletting to other businesses, will go back to being fulfillment centers as demand for online goods picks up. Cloud computing, Amazon's most profitable segment, is expected to triple by the end of 2030 to over $1.5 trillion. So Amazon Web Services has a lot of runway left to cover. Things look bad right now for Amazon, but it's not something they can't recover from, and they're still growing. Amazon's rise in its share price is a positive and welcome development for the company, and is poised to grow further once it emerges from the recession. Like and subscribe.